Today, I want to start off 2022 with a company that might seem as simple as its classic glazed donut, but may be one of the sweetest deals to come on the market. It's a company that's been perfecting its recipe since 1937 and is instantly recognizable by its classic green logo. We're exploring the king of donuts, Krispy Kreme. Hey everybody, and welcome back to Dollars and Cents, helping you make sense of making dollars. Krispy Kreme's story starts in 1933 with an 18-year-old Vernon Rudolph. Rudolph first made donuts in a general store owned by his uncle in Louisiana. 4 years later, Rudolph moved to open his own store, Krispy Kreme, in Winston-Salem, North Carolina. Eventually, the fledgling donut maker expanded to a handful of mostly family-owned stores. Throughout the 1940s and 50s, Rudolph built a mix plant to make the iconic donut mix and deliver it to the Krispy Kreme stores. But the 1960s and 70s proved to be the company's defining decade. During these decades, Krispy Kreme rapidly expanded throughout the US, plus that iconic green tile pattern was created around this time. But tragically, founder Vernon Rudolph passed away in 1973, and just 3 years later, in 1976, his prized company was sold to Beatrice Foods, and honestly, this wasn't a bad thing at all. Actually, the sale ultimately benefited the donut maker. Beatrice Foods invested a lot of money into Krispy Kreme, opening stores from coast to coast in the US and even outside of its borders. All of this ultimately culminated in the company going public in the year 2000, but that unfortunately would prove to be a very, very bad idea. Krispy Kreme straight up did not have a good time in 2001. An earnings call miss caused the stock to fall 80% in less than a year. Questionable accounting practices led to multiple lawsuits launched against it, yet somehow the company remained on the market until 2016, when a German investment firm JAB finally bought the company and took it off the market. Fast forward to July 2021, Krispy Kreme once again launched its IPO with a brand new ticker symbol and a renewed focus on growing its core business. And it does look like the company is taking steps in the right direction. But before we get into all that, let's take a look under the hood at the company's financials. And one quick note before we begin, we only have 3 years of financial data available to us, so we're just gonna have to go off that. First, of course, is revenue growth. In 2018, Krispy Kreme brought in $796 million. Then, in 2020, it brought in an impressive $1.12 billion, and has had seemingly fairly consistent revenue growth. Usually, our second metric would be shares outstanding. However, since the company has only been public since July of 2021, it's unclear if Krispy Kreme will dilute shareholders or buy shares back. Although it does seem that Krispy Kreme has issued about 2 million new shares since going public. Third on the list is free cash flow growth. In 2018, Krispy Kreme reported a loss of $95 million in free cash flow. In 2020, it reported a loss of $144 million. Highly concerning to see its losses growing at nearly the same rate as revenue. Now I want to take a look at Krispy Kreme's last 3 years of EBITDA and compare it to its net debt. Over the last 3 years, it has had an average EBITDA of $89 million. Its net debt as of now stands at $1.61 billion. That means Krispy Kreme needs 18 times its average EBITDA to pay off its debts. And this is well over our goal of 4 times and fairly concerning. I do want to note though that most of this debt is capital lease obligations. CLOs are largely loans on buildings. Many companies with tons of stores often have high amounts of this CLO debt. Take for instance Walgreens. Half of its debt is CLOs alone. So just something to keep in mind with Krispy Kreme as well. Normally we'd get to a rough stock price using a company's free cash flow average. Given that Krispy Kreme hasn't turned a profit over the last few years, I don't have anything for this area. However, in their most recent report, it seems the company has posted positive free cash flow for the first time I've seen, so hopefully this trend continues. Also, we can't get an accurate return on invested capital because the company has consistently lost money since its IPO and hasn't been on the market that long, thus we can't get an accurate 5-year return return on invested capital, and last year's ROIC clocks in at a negative 2.8%. Despite all of these losses, Krispy Kreme just paid its first dividend, paying 3.5 cents per share with a dividend yield of 0.80%. In total, the company paid out about $5.6 million in dividends, meaning its payout ratio is right around 50%, and hopefully this trend also continues moving forward. Ultimately, I think the mess of Krispy Kreme's balance sheet is because it's so new to the market, and JAB Capital made operating at a loss possible for so long. But now it seems the company is sort of getting back on track, and so it's going to be really interesting to see if the company can continue the momentum it's had in its most recent earnings calls. So with that knowledge of the financials, I'd like to look at the company itself and figure out if investing in Krispy Kreme is a sweet deal or a recipe for disaster. Let's break it down. Most of Krispy Kreme's marketing revolves around the overhaul of the old business model in favor of a new direction. In its most recent earnings call, the company stated it had transitioned away from franchise stores to mostly company-controlled stores in order to make the new hub and spoke business model more effective. And this model is nothing new. In the hub and spoke model, the company operates a central hub where products are primarily made. This hub then supports the surrounding locations or spokes. For Krispy Kreme, the hubs are the factories or theater shops where the donut mixes are made and shipped. The spokes are the surrounding locations which then bake and sell the donuts. And it seems to be working. The company expanded its influence to over 10,000 access points, nearly doubling the number from 3 years ago, and it also operates in over 30 countries. A look at the numbers reveals that Krispy Kreme posted an impressive 18% revenue growth year over year and a solid organic growth rate of 6% last year. And if you want to help the organic growth of this channel, be sure to sub and like below. In terms of the core business though, Krispy Kreme has a lot to prove. While its new business model is working, the real test will be if the company can sustain that growth in the coming years, especially if Krispy Kreme plans to continue expanding and making smart acquisitions like Insomnia Cookies. Under JAB, Krispy Kreme acquired the cookie maker and the business really started to take off. Interestingly, it operates almost entirely online, though it did just open its 200th US store. On top of that, Insomnia Cookies managed to grow revenue by 43% last year alone, and the cookie maker now accounts for over 30% of Krispy Kreme's total revenue. And it's this company paired with Krispy Kreme that makes such an incredible partnership work. Honestly, it sort of reminds me of Amazon in a way. When Jeff Bezos created Amazon.com, he used the profits from that business to incubate the then very small Amazon AWS, a cloud hosting service that now dominates its market. And its ultra-high margin business allowed Amazon to become even bigger, generating massive amounts of cash. And I think it would be really interesting if Krispy Kreme were to be able to do the same thing. I can see it happening. Krispy Kreme's main business has grown big enough to incubate the smaller but ultra-high margin business that is Insomnia Cookies, and the excess cash that Insomnia Cookies generates can then be pumped back into the main business and you just repeat the cycle. And this isn't to say that I think that Krispy Kreme is the next Amazon, but I do think the comparison is interesting. But as with all good things comes the not so good side too. Any investor worth his salt needs to look at the spoiled parts of any business like Krispy Kreme to make a holistic decision. First and foremost is the massive amount of debt. It's interesting to me that most of the money raised from the company's IPO will go directly to paying off the Insomnia Cookies acquisition. Krispy Kreme has $1.6 billion in net debt and hasn't really proven that it can sustain positive free cash flow. And the road to positive free cash flow is going to be steep. Lacking the ability to generate enough cash might result in the company needing to add more debt or issuing shares, thus diluting shareholders. And I really want to believe that JAB management had this all planned out when it took the donut maker public. And I mean, Krispy Kreme did go public for a reason, although I'm not sure on what the definitive reason is. And something that makes me quite mad is that Krispy Kreme had actually fought the long hard battle towards profitability up until 2016. In 2015, the company had generated $32 million in net income, at least according to the earnings call of that year, and it had started buying back shares and stockpiling cash on the balance sheet. And this is certainly a recipe for success. Now the new Krispy Kreme instead reports a $51 million loss in net income, and maybe that's due to the switch in the new business model, but is it worth it when we see these abysmal numbers? It seems like JAB eroded a good deal of what made Krispy Kreme such a solid company. By these actions, it makes it seem like JAB tried to turn this boring old donut business into some flashy growth story, and honestly, I don't think it really works all that well. And while it is true that Krispy Kreme posted a 6% organic growth number last year, it's important to realize that that is not the core donut business, you know, the thing that generates most of the revenue, and that grew by a pitiful 1% last year. Almost all of that organic growth came from Insomnia cookies. The lack of profitability, I think, is really going to constrict Krispy Kreme's ability to continue to grow, and Krispy Kreme faces a long, hard road ahead. I think the biggest focus of the business should be on turning a profit. The company already demonstrated that the new business model seemingly works. Now Krispy Kreme just needs to get to that 15% EBITDA margin it touts on essentially every earnings call. And so that leaves us with the question, am I buying Krispy Kreme? The answer is no. The business seems a little all over the place to me. I'm still excited about the company's growth prospects, but the road it faces ahead is formidable. And with all that said, I'll still maintain that Krispy Kreme is my top stock for 2022. I'm going to be watching this business very closely, reading every earnings call and seeing if it can continue down the good path that it started on. Right now, I just think there are too many unknowns that I can't account for, and for that reason, I'm out on this deal. As for a price target, I don't really have one. I tend to think that the business is worth around $1.5 billion, which would put the share price in the $8 to $9 range, and we got pretty close to it recently too, so maybe a buying opportunity in the near future for the believers. And that's all I've got for you in this video about Krispy Kreme. Leave your thoughts on the company and your favorite donut in the comments down below. Until next time, you can join my Discord if you want to talk more, and I will see all of you in the next episode of Dollars and Cents.